The clock is ticking down on one of India's longest pension disputes in Indian history, a 30-year pension updation judicial fight. I'm Nisha Bhattacharya with co-host Priyanka Chakraborty.
Well, clearly, it seems like everything is converging on a single high pressure 11th hour meeting ahead of the Supreme Court hearing of the MC Singla case, Thursday, 15 January.
That's right. We are diving into a truly critical test of financial fiduciary duty, and this is specifically concerning the banks.
That's the consortium representing India's banking sector.
Exactly, and a massive corpus fund actuarially valued at 4.57 lakh crore rupees or 50.6 billion.
The timeline is just razor sharp. Supreme Court has set a final hearing date, and immediately before it, on January 14th, 2026, the IBA has called this urgent kind of sudden meeting with all the major trade unions.
So 30 years of inaction and then all of a sudden this immediate urgent speed. That's really the core tension we're looking at today.
Our source outlines an extraordinary shift and his 5 reasons behind this sudden enthusiasm.
If you're enjoying this podcast, please consider subscribing, sharing, liking, and commenting.
When you engage with our podcast, the YouTube algorithm promotes it to even more people.
The real battle is timing versus exposure. Banks face a choice: settle fast or risk exposing decades of financial scrutiny.
Or do they risk the full weight of judicial exposure? That's the question.
We are here to expose the stakes, the alleged regulatory failures, and the trade union's explosive 11th hour move that's turned this entire battle into a controversy.
Also, you can clearly see the motivations driving these resolution attempts.
Right? So let's ground ourselves in the history and, of course, the deadline.
The core dispute here is pension updation.
It's been pending for 3 decades. For anyone who might not be familiar, what exactly does updation mean here?
In simple terms, pension updation means adjusting the older retirement benefits of bank employees to reflect, well, current or revised pay scales.
Okay,
Think of it as just ensuring that pensions that were awarded decades ago can keep pace reasonably with economic realities and the compensation structure of the industry today.
and the banks, they've resisted or stalled the fight for updation for a long time.
Oh, for decades. It's created this massive legal and administrative logjam.
And now it seems that logjam is hitting a wall. The final Supreme Court hearing is set for January 15th. The meeting is called for January 14th, 2026, just one day before a potential judgment.
And this sudden urgency isn't just about avoiding a legal loss. The sources we have suggest it's fundamentally about the financial records the court might demand.
Okay, so it's about the paper trail.
Absolutely. The first major reason for the bank's haste, it centers on the financial scale. If the case proceeds, the banks knows the court will demand a full real-time financial position of the pension corpus fund.
Which means showing the records.
Right. Immediately.
And that number is just staggering. We're talking about a corpus fund of, what is it?
It's 458 lakh crores rupees.
Wow, that's a fund representing the retirement security of tens of thousands of people, managed over 3 decades. So why would the court demanding records of a fund that big cause such panic?
Because the sheer size of it makes the requirement for transparency just enormous.
Okay,
If the court rules against the banks or demands a full accounting, they will have to present the profit and loss, the P&L and the cash flow statements for all 30 years of that fund's existence.
all 30 years?
Every single one. It's a core of the legal discovery process here. The court would get access to every investment decision, every accounting maneuver, every return achieved over 3 decades.
So the fear isn't just about paying the updation. It's the fear of what a mandatory audit of those years might reveal about how that massive fund was managed.
Exactly.
The presentation itself is where it gets interesting because it's not just about what they should pay, but what they actually did with the money.
Precisely, and that transitions us directly into the really serious regulatory red flags that are, reportedly waving in the background.
Right. Although at this point we must add a disclaimer and stress that what follows is pure speculation and hypothetical. And neither the unions nor the banks are accused of any irregularities or misconduct.
Our sources link this pressure to existing pending investigations by the CBI, the Central Bureau of Investigation. So the risk of judicial exposure is multiplied when you already have investigations underway.
Okay, so let's talk about the specific allegation that's mentioned in the sources, because this is where a potential breach of trust becomes crystal clear. What is the alleged manipulation claims made against the banks?
The source material highlights a very specific and frankly very worrying allegation. It's the reported diversion of part of the PF funds, that's the Provident Fund, to the P&L account, the profit and loss account.
Okay, help us define those two buckets quickly. The difference between PF and PNL and why moving money between them is so potentially damaging.
Sure. So the Provident Fund, or PF, is a dedicated, almost sacred trust. It holds the statutory, mandatory contributions made by employees and employers specifically for retirement.
So it's legally ring fenced.
It's supposed to be. The P&L account, on the other hand, that tracks the operational revenues and expenses of the bank itself. The source alleges that a diversion might be carried out to save balance sheets from going into the red.
So we are talking about allegedly money movement from a dedicated, legally ring fenced retirement trust fund.
Yes, pretty much.
And just parking it in the operational accounts to essentially mask operational losses or maybe boost profits for a reporting period.
That's the allegation and claim.
If it were true, that's not an accounting error. That's a potential fundamental breach of trust and regulations.
If that allegation is true, it suggests a profound manipulation of financial statements using money that belong to the employees to improve the short term financial optics.
To make the balance sheet look healthier than it was.
Exactly. And if the court forces a 30-year forensic audit, the source suggests that is precisely the kind of skeleton in the fund management closet that will come tumbling out.
What are the real world consequences if these kind of mismanagement are confirmed in court? Well, it raises that important question again. Is the goal of this meeting really a settlement or is it fundamentally just damage control?
Right.
If the banks are forced to give a true picture of the fund management to the Supreme Court, it leads to two immediate high stakes outcomes. First, massive institutional embarrassment. But more importantly, immediate personal accountability.
There you go.
For senior bank officials and managers who oversaw those funds for the last 3 decades, so the urgency of this January 14th meeting suddenly looks a lot less like generosity.
And a lot more like a desperate preventative measure.
Exactly, to manage their legal exposure.
So, if the threat of exposure is that high, then the strategic move is to get all the legal cases withdrawn before the court can issue any kind of disclosure order.
That's the logical possibility.
Sources outline a high risk escape route. Banks could diffuse the 30-year pension fight by offering a January 14th solution acceptable to all retirees, a bold move after decades of resistance.
An immediate satisfying resolution for the people who are owed money.
Right? It seems perfect on the surface.
But as always, there's a critical condition attached.
Precisely. The acceptance of this updation offer would be explicitly conditioned on the pensioners agreeing to immediately close and withdraw all outstanding legal cases with the Supreme Court.
It's a classic trade off, guaranteed benefit for you now in exchange for guaranteed silence about the past later.
And if we connect this to the bigger picture, the so what of this tactic is just monumental for the banks.
How so?
If cases are withdrawn, the court loses power to demand a 30-year audit and probe alleged financial maneuvers, claims, and skeletons about the PF fund, etc.
They would remain unearthed forever.
The motive is clear: resolve the issue while shielding past management decisions from scrutiny over how they handled the massive pension fund.
They resolve the present liability while making sure the past stays buried.
The source adds a final sort of cynical flourish to this strategy,
What's this?
noting that if they're successful, the banks could conveniently just pass the buck to future managements. They stabilize the ship now, but ensure the financial handling of the past is never scrutinized by the judiciary.
The core goal is just managing judicial exposure and financial impunity.
It's a classic example of financial entities using a strict legal deadline to trade, public unavoidable accountability for a private controllable liability.
Which brings us to the second and equally important half of this whole crisis, the controversial role of a major internal stakeholder.
A trade union that remains unnamed.
Allegedly, this union's involvement is critical for any negotiation to succeed, but the source makes some really serious claims about their past actions.
And we have to report these claims impartially, but they are absolutely central to the dynamic. The sources allege that this union played a, quote, debatable role in the past by actively consenting to the creation of a two-tier pension formula.
A two-tier formula, and this action specifically discriminated against a major group of retirees.
The pre-2002 retirees, a huge cohort.
Why would a union, whose whole purpose is to protect all its workers, agree to a system that discriminates against its older retirees? I mean, what does that two-tier system actually mean for the people it affects?
It means that the retirees who worked under the older structure, the pre-2002 group, they receive significantly lower annual pension adjustments and benefits compared to later retirees.
So they were marginalized?
It created an unequal retirement system. And if the allegation holds, the union spent decades favoring one group over another, triggering the very legal battle now erupting.
After decades of alleged discrimination, why is the majority union suddenly pushing to resolve updation now? And what triggered this dramatic shift?
Well, the majority union current position is conditional and it kind of mirrors the bank's strategy. They'll negotiate and resolve the updation issue,
Really? Just like that?
but only if the retirees drop all their cases in court.
So the same condition?
And this sudden, very visible love for pensioners after 3 decades of alleged opposition or just silence is what the sources are finding very worrying.
So what's their interpretation? The source offers a profoundly cynical one for this timing.
They argue that the union fears the retirees are now actually likely to win the updation case without any union intervention purely through the force of a Supreme Court ruling.
So it's a calculation of reputation and control before the judicial axe falls.
Exactly. If the retirees win because of a court order, the union is exposed. It would demonstrate that the union was either incapable or unwilling to secure the benefit for them.
And that would cause a dent or damage to their reputation.
It shows the union risks looking irrelevant and maybe about to miss a major political and financial opening.
And this opportunity, according to the sources' claims, is the chance to create a bond of gratitude.
By solving updation through negotiation, they avoid a court imposed judicial decree.
And this bond of gratitude, I'm guessing, isn't purely sentimental.
No, the goal is to recast the union as a benefactor, to regain influence and secure financial rewards from a grateful block of bank retirees.
The fear of a court imposed outcome pushes both banks and the union into a last minute negotiation pressure cooker.
It really is. Both parties seemingly prefer a controlled private settlement outside the courtroom, even if it means immediately fulfilling a 30-year-old demand.
It just demonstrates the power of a hard deadline.
It does. The Supreme Court hearing is acting as a forcing function, compelling action from two entities who historically benefited from inertia and delay.
So, as we wrap up, we see this perfect storm just converging on January 14th. You've got the 30-year pending issue finally demanding resolution.
You've got the massive Rs 4.58 lakh crore corpus fund forcing financial scrutiny and accountability.
And the majority union scrambling to reassert control over the outcome to secure political and financial advantage.
The sources say we must wait for the 15th to see how the court battle truly unfolds.
The forward path for these pensioners really depends entirely on whether the involved parties manage to forge a swift negotiation that buries the past.
Or whether they are forced into the full transparency and, well, the accountability of litigation.
For listeners, cases like this show how legal timelines can force powerful players into tough, high-stakes choices.
So, what does this all mean for you, the listener? Is this settlement for beneficiaries or a way to avoid exposing decades of fund management?
Thank you for joining us for this deep dive.
Please like, share, and subscribe until next time.